If you're into trading, the opening range breakout strategy is one of the most widely used trading methods that helps identify high-probability trade entry setups every single day. Regardless of market conditions, whether you're swing trading stocks or trading intraday. Although many traders know about this strategy, a lack of clear understanding often causes common mistakes, leading to losses. So, in today's video, we'll break down the opening range breakout strategy step by step and see exactly how it functions. We'll also discuss how to combine this strategy with price action and smart money concepts to spot the most effective trade entries. But before we dive in, if you find this content valuable, make sure to hit that like button. And if you're new here, don't forget to subscribe and enable notifications so you never miss our upcoming videos. I'll catch you right after the intro and disclaimer. As the name implies, the essence of this strategy lies within its concept. When we divide it into two parts, we get two main ideas: the opening range and the breakout. The opening range refers to the price area formed from the start to the end of a specific range. When this zone breaks out in either direction, we call it a breakout. This makes the strategy quite practical to use. To apply it, we first need to outline the range on the chart. Only after doing so can we take a trade when the price breaks out of that range. In this approach, we won't mark the internal or external ranges forming on the chart, as doing so would create a large zone, limiting our trade opportunities. Therefore, this strategy focuses on using a single candle as the range. Now, you might be wondering which time frame and which candle should be selected to form a high probability setup. In this method, the time frame depends on your trading style. If you're a swing or positional trader, you can apply it on a 1-hour or 15-minute chart. If you prefer intraday trading, you can switch to shorter time frames like the 5-minute or 3-minute chart. Both approaches yield similar results. In swing trading, positions are held for a longer duration, so using higher time frames helps filter out minor market fluctuations. On the other hand, intraday traders focus on quick entries and exits within a limited time. Hence, smaller time frames suit them better. Now that we've determined the time frame, let's move on to identifying which candle should be marked on the chart. Many traders mark the first candle of the day as their opening range. While this works to some extent, it doesn't always produce the expected results. If you observe the initial candle on a chart, you'll notice that it's often very large at market open. When we plot the highs and lows of such candles, we end up with a wide range, which means we must wait for a breakout from a large zone. In many cases, the price stays within that range for the entire session, and no breakout occurs. Because of the high volatility during the market's opening moments, prices tend to fluctuate rapidly. This often triggers stop losses and leads to unplanned overtrading. To avoid such volatile conditions, it's better to let the market settle down first. There isn't a fixed rule to determine when volatility has decreased, so we must interpret it through candle behavior on the chart. For instance, in this chart, as soon as the market opens, a strong red candle appears, and prices drop sharply. We mark this candle's range and prepare to enter a trade upon its breakout. The market continues downward, forming another large red candle similar in size to the first one. Once the range breaks, we enter a short trade as planned. However, immediately after entry, a big green bullish candle appears, causing a sudden market reversal. Our stop loss is hit, and we're forced out of the trade. Now, is this the fault of our strategy or the market? It's neither. The issue lies in executing the trade without proper understanding. Because of incorrect timing, our stop loss was triggered. Along with that, our confidence took a hit early in the day, negatively affecting our trading psychology. Every strategy only delivers consistent results when applied at the right moment and in the right context. To ensure this, we must follow a few essential rules. Rule 1. The first 10 minutes of trading are the most volatile. Avoid marking the opening range during this time. Rule 2. If the initial candles are unusually large instead of normal-sized ones, wait until a regular-sized candle forms before marking the range. Rule 3. When marking your candle range, always include the wicks on both sides of the candle while drawing your zone. For instance, this is a 5-minute time frame chart. Because of the market's early volatility, after the formation of large candles. Around the fourth candle usually appears of normal size. At this point, we can mark our candle's opening range. This makes the breakout zone much smaller than that of the first candle, increasing the chances of a breakout and helping us enter a trade at the right moment. Additionally, if you're trading intraday and mark the candle range on a 15-minute chart, the area covered will be quite large. But if you switch to a 5-minute chart, the range becomes slightly narrower. And when you mark the high and low of a 1-minute candle, the range shrinks even further. However, this greatly raises the chances of encountering a fake breakout signal. Therefore, it's best to stick with a 5-minute time frame, or at most, a 3-minute one, and avoid going below that. Now that we understand how to mark a candle range, let's move on to how we can enter a trade. In the candle range breakout strategy, an entry is made once the price breaks out of the marked range. For example, here we've marked this candle's range. When the price breaks this range, we'll take our entry at that point. There are 3 commonly used methods for entering a trade after a breakout. Method 1. If the market breaks our range with a strong candle, we can go long immediately at the close of that breakout candle. But always remember, until the candle fully closes outside the range, it's not a confirmed breakout. At times, the candle may move above the range but then fall back and close within it. This invalidates the breakout. Therefore, we'll only consider it valid if the candle closes completely outside the marked zone. However, this single candle breakout method carries the highest risk of being caught in a false breakout. Often, the candle closes near the top, but the next one pulls the price back down. This type of setup involves high risk, so it's best to avoid single candle breakouts whenever possible. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 10th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500 plus 61% off for pre-bookings before October 10th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Method 2. After the price breaks the range and then pulls back to retest it, we look for bullish candlestick patterns near the retest level and enter the trade at the high of the retesting candle. In such setups, the retest candle usually forms with a long lower wick, showing that sellers tried to push the price down but failed to close lower. This indicates that buyers are still active and pushing the price back up, giving a strong bullish signal. In this method, instead of waiting for the range-breaking candle to move above the previous high, we enter at the breakout of the retesting candle's high, placing the stop loss just below that candle. This approach gives us a smaller stop loss and a better risk-to-reward ratio. Still, placing a stop loss is essential. Method 3. Here, we wait for the price to break the previous swing high after the retest. We then enter the trade at the high of the breakout candle, keeping our stop loss below it. Since this method involves waiting for a breakout beyond the previous level, our entry point is higher than the marked range, which increases risk. With a wider stop loss, this method doesn't offer the best risk-to-reward ratio. Therefore, we generally avoid this approach. Hence, focusing on the second method tends to be the most effective. This same technique can also be used for entering short trades during a bearish trend. The entry rules remain nearly identical, the only difference is the trade direction. Now that we've finalized the breakout entry method, let's explore how to combine this strategy with the smart money concept. Now, in this chart, after a sharp downward move, the price has bounced back and formed a normal-sized candle at a higher level. This indicates that the market reached this level early in the session and that volatility has eased. As momentum slows, candle sizes return to normal. At this point, we can mark our candle range by highlighting the high and low of this latest candle. Afterward, a green bullish candle forms, and the price drops back into our marked range, creating a strong bullish rejection candle. You might wonder why I'm referring to it as a bullish rejection candle when it appears red. To understand that, we must look at the strength of buyers and sellers within this candle. After opening at this level, buyers initially pushed the price slightly upward, but sellers stepped in with heavy pressure, driving the price down. However, near the lower levels, buyers re-entered strongly, pushing the price back up and forcing it to close higher. This shows that sellers failed to maintain control. Hence, this candle reflects bullish strength. Some traders refer to this as a bullish pin bar or a hammer candle. From a price action perspective, this situation shows buyers are trying to regain control of the market. Now, if we analyze this chart through the lens of smart money concepts, you'll notice a clear gap between two candles. This is known as a price imbalance or fair value gap. The lower wick of this rejection candle touches that gap area, signaling that all pending orders there have been filled. As a result, the price faces rejection and bounces back upward. Some traders might say this candle only touched the upper portion of the gap, so, is that still a valid rejection? The answer is yes. To clarify, there are 4 types of rejection patterns. In the first, the candle only touches the upper part of the gap. In the second, it reaches the midpoint, 50%, before reversing. In the third, it touches the lower end. All 3 are valid rejections since the price never breaks below the fair value gap area. However, in the fourth case, where the price breaks completely below the gap, it's considered an invalid fair value gap. In this example, the long lower wick shows clear rejection at that zone, suggesting bullish momentum is likely to build. Therefore, to enter a long trade, we can set an entry at the high of this candle, place a stop loss below its low, and target at least twice the risk amount for profit. Even if the market moves against us, the fair value gap below acts as support. This forms a solid plan for a long trade setup. On the other hand, if the market breaks below our candle range and forms a bearish candlestick pattern, we can use the same fair value gap principle for a short trade. If a candle enters that area, faces rejection, and moves downward, we'll enter a short trade there, with a stop loss in place. Additionally, when applying the opening range breakout strategy, a few important factors must be kept in mind. The price should stay within our drawn range and then break out from the upper level for a long setup. However, before executing any trade, always check key zones on the chart. Shift to a higher time frame to identify whether any major resistance exists near your entry point. Markets often respect higher time frame levels, which can cause sudden reversals. So, if you're entering on a 5-minute chart, also examine the 15-minute or 1-hour chart to spot those crucial zones. Doing so will help you avoid getting trapped in the market. That's all for today, traders. Thank you for watching this video. Success isn't a matter of luck, it's the result of hard work, patience, and unshakable belief. If this video fired you up, make sure to hit that like button right now. And if you're new to the channel, don't forget to subscribe and turn on the notification bell so you never miss another dose of motivation. Stay focused, keep grinding, and sharpen your mindset every single day. I'll see you in the next video.